At what point and why does a trading setup occur? How to correctly work with a stop loss. This downward trend no longer has the same energy it had when it was first developing. We can open a long position. Once the position is open, we can only close it by hitting the stop. All you need to do next is keep working with the stop until the trend runs out of steam. Hello friends, you're on the Old Trader channel. My name is Vladimir Karashev. Today we're going to talk about Netflix. We love stories that are dynamic. We've already made several videos about this company. Videos where we discussed in detail how the price moves, when and why a trading setup occurs, how to calculate risk, how to make trading decisions, when to open a position, and how to correctly work with a stop loss. Let's continue our conversation about Netflix today. Be sure to watch this video to the end. As always, the most interesting part is at the end. And now let's go straight to the chart. After we saw a downward movement on a large time frame, on the monthly time frame for Netflix, and notice right here in February 2026, we have a breakout of the previous month's candle body highs from January. That's it. We understand that at this point, the downward movement is over. The energy that was pushing this stock in a certain direction has left the trend, and now we can start looking for a good trading setup. What do we need for these, friends? Let me remind you once again that applied trading in the stock market is mathematics. This is something you need to clearly understand. And the price always moves according to certain models. Yes, often the amplitude of these models changes slightly, the timing of the model changes slightly, but in principle, we almost always have repeating patterns. This is very important. And the ability to see such models, such reversal models, after which the price starts to go in the opposite direction, is very good expertise. It's a good skill, and I really hope that over time you will definitely master this skill. So let's continue. After we saw the breakout of the January monthly candles highs in February, that's it. At that point, you need to move to a lower time frame, that is, switch to the weekly time frame and wait for a good trading setup as a corrective model forms. So let's remember we have 2 months, the first month, the second month. The maximum value in March is at the level of $100.19. Now let's switch to the weekly time frame. Here is the situation. The maximum value is $100.19, and we're watching for the formation of a reversal model. And what do we see as a result? The correction develops over 3 weeks, the first week, the second week, the third week. This is a shallow correction, which indicates that the trend we saw before, this downward trend, no longer has the energy it had when it was developing. And if a good trading setup occurs, we can open a long position and then work with the stop loss. And such a situation arises. Notice that after 3 correction weeks, a breakout occurs and a position is opened at the breakout of this week's highs. Late March, let's look at the high together, $95.86. And here, a position opens at the moment of breaking the highs of this last correction week. The position opens. Crucially, friends, the stop loss goes immediately under the lows of the last correction week. When the position opened, the stop was at $90.82, right here. After that, and this is vital, once the position is open, we can only close it by the stop. If the position goes against us, we close out and lock in a small loss. If the position goes our way, we trail the stop loss with the trend, which is what's happening here. The week we opened, the position ended and the next week began. We moved the stop from here, let's use numbers, from $90.82 to here to the level of, let's see, $92.22. The next week ended and the current one began. We moved the stop from $92.22 to the previous week's low. That's the level of $97.44. And currently, for the current week, the stop loss level is the low of the previous weekly candle, including the lower wick. I'll repeat, that's the level of $97.44. The trading setup where we entered the position is at the level of, let's check again, $95.86. So the position is already in a break-even state. And once again, all that remains for us to do is to continue working with the stop, maintaining our approach until the trend eventually runs out of steam. For the upcoming week, if we do not fall below the previous week's low, we will move the stop from $97.44 to the low of the next weekly candle, which is $102.06. This method allows us to protect our gains while still giving the trade enough space to develop as the trend continues. For the following week, right now the stop loss level is the low of the last weekly candle, including the lower wick at $97.44. We've discussed the trading setup and managing the position with specific numbers. This is vital because we often hear market expertise that fails to clarify. First, the entry point, second, the stop loss level, and third, how to manage the position, when to close it, when to trail the stop higher, and so on. Technical analysis helps us understand, first, when to open a position, why the entry timing is right, and why the stop level is tight. And most importantly, my friends, after opening a position, it's the ability to manage the stop loss within that position. This is very important. Let me remind you of the key point once more. You can open a position at the right moment using a specific trading model that is most comfortable for you, but you can only close it with a stop. Why is that? Because we don't know how strongly the trend will develop. A trend can go in our direction by 5%, 10%, 50%, and so on. And here it's very important to hold a profitable position as long as possible. But when the trend ends, let go of that position without regret, take the money, and wait for new trading setups. Friends, that's all for now. Be sure to subscribe to our YouTube channel. Good luck to everyone and profitable trades to all. We'll hear and see you soon.